Excellent. Thanks very much, everybody, for joining us. We have two fabulous panelists here. I'll quickly introduce myself. My name is Chris Tyler. I'm the president of Bullish Exchange. Bullish is an institutionally focused exchange founded in 2021. Tim, can I ask you to introduce yourself?
Yeah, very nice to meet everybody. My name is Tim Kwok. I work for Talos. Talos is an institutional trading platform for the full end-to-end life cycle of the trade. We were founded in 2018.
Yep. Hi, my name is Ambre Soubiran. I'm the CEO of Kaiko, and Kaiko is a global market data and analytics company in the crypto space.
Excellent. Okay, so I want to start with you, Ambre. I think that in terms of new participants looking at a new asset, data is one of the first things that they need. Data is like the starting point. Okay, let's get underneath the skin. Let's see how this trades. Let's see where it trades, et cetera, et cetera. I'd love for you to set the scene as we talk about the future of crypto markets. To really set the scene, Kaiko has been out there since 2014, one of the oldest and most prestigious data companies in crypto. How has that evolution been? What did that look like at the beginning in terms of client segments? How does that look today? And then what are some of the conversations that you have that give you visibility into the types of market participants that are entering the space?
Yeah, so clearly we've seen this evolution of not just the products, but the kind of associated users and power users of the product. When we started off, the only thing that was there to trade cryptocurrency were centralized trading venues, right? So when we started, we aggregated data from all of the centralized cryptocurrency exchanges globally and made that available in a consolidated API. And it was more investors that were crypto native, trying to do arbitrage across exchanges. And at some point we had ICO summer, so people were trying to apply valuation models on the price of tokens and trying to use proxy prices to see how much this thing should be valued, et cetera. So it was very, I would say, still quite unsophisticated and very crypto native. Then we had DeFi summer, so what we started doing is extracting directly from the blockchain all of the market data that emanated from DeFi applications, initially DEXs and then lending and borrowing protocols. And that is interesting, and it's grown significantly today in terms of relative volume. DEXs now represent a significant portion of global traded volume. So we've added all of those kind of on-chain read capabilities. And that is extremely interesting because I think from a data provider standpoint, what we're bringing is this knowledge of having to read seamlessly from traditional market data pipelines, such as APIs and just exchange data, but also give meaning to financial market data generated on blockchain infrastructures and deliver that in a way that is compatible with consuming that on the client side. So that was kind of the DeFi evolution. Then derivatives became a thing, derivatives exchanges. So we started adding all of the derivatives market data, but then also deriving from derivatives market data all of the risk metrics that are traditional in traditional finance, such as implied volatility surfaces, sure, value at risk models, like developing all those quantitative analytics tools to measure risk and to be able to trade crypto better. So that was kind of the crypto derivatives evolution. And then finally, we got into the world of ETFs, ETPs, and that is the world of more traditional financial products giving some form of synthetic exposure to crypto assets. And for that, we developed a suite of solutions called Kaiko Indices, where we provide benchmarks and indices that are investable. And I would say we've basically, followed our product development cycle follows also the level of maturity of the industry, where we went from unsophisticated crypto people arbitraging centralized venues all the way to now addressing asset managers that are creating ETFs or ETPs and that are addressing a broader set of non-crypto investors. So that's how I've seen the space evolve the past 10 years.
Awesome. And then, I guess, Tim, from your perspective, once clients or once firms have decided that they want to engage with this asset, they've got the data, they've been to Kaiko, they've realized that this is something that they want to invest in. The next step is really to define what is the operating model, how do they engage. That's when I imagine, you're at the tip of the spear of seeing who's coming into the space. How have you seen that evolution, from your perspective in terms of client types and how that's progressed over time?
Yeah,
and particularly how it looks going forward.
So in 2018 and 19 and 20, when we first started the business, we typically have seen a significant amount of buy-side participants, meaning hedge funds or arbitrageurs and things like that. And then through the years, as the market has matured, we'd also seen a sell-side kind of contingent come into place, right? So Talos effectively powers the ecosystem on both sides of that. We have buy-side customers as well as sell-side customers. Our buy-side customers are hedge funds, asset managers, family offices, systematic and quant shops. And then on the actual sell side, we power a lot of the retail brokers or the payment apps, right? I would say a lot of that business, meaning powering, the Robinhoods of the world or those types of customers, large retail brokers and things like that. That has come through the years, and that type of business now has become, much more important as crypto has become much more mainstream as well, right? So what we've seen in terms of the product development as well is advanced algo execution, kind of that capability, but now everybody's looking at risk and compliance tools.
Okay.
Right? So how can you properly, to your point about operating model, how can we operate in a safe and compliant space in terms of who my counterparties are, where my positions are, who I'm actually trading with, exchanges, OTC providers. Now there's obviously a large movement around tokenized assets as well as FX and stablecoin movements. So now there's FX exposure that you need to. And effectively what we've seen now through the years is that a lot of the businesses are now looking at it. I want to look at my equity risk. I want to look at my fixed income or yield risk. And then also I want to look at my crypto risk in one place. So we've seen a lot of that type of kind of evolution in the space for infrastructure and needs from our customer base.
Okay, that's great. And then, look, I think one of the things that we're starting to see, and it sounds like from the pipelines that you're describing, we are starting to see a lot more institutions come into the space. We've had the ETFs, which really, I think, provided the first real bridge between, the crypto ecosystem and the legacy financial system, in as much as effectively we've securitized Bitcoin and other digital assets. How do you, and I'll start with you, Tim, how do you see, the traditional legacy financial system and the crypto ecosystem continue to converge? What do you see as the next major events there?
Yeah, it's a really good question, and it's like how we've seen it from the traditional type of customers coming into the space is it needs to kind of fit into their existing ecosystem currently, right? That's been a very important kind of language and kind of conversation that we've had with them, meaning they're operating, let's say I'll use an example of an asset manager. They're a long short equity asset manager. They've been operating like this for 25 years or something like that, right? The system works how it works, right? It's like moving a battleship in terms of that, right? So effectively, what they've wanted is how can Talos be modular in nature or systems like Talos being able to kind of accommodate for those types of needs. We've also seen the other side where crypto native is a lot more nimble, right? So effectively, they can do everything end to end in Talos in one place. Pre-trade, execution, post-trade, and all those types of capabilities. It just kind of depends on exactly what type of risk tolerance you want to do, what pieces of the stack that you want to own, and effectively what we've seen is a lot of folks are now de-risking themselves from the operational parts of things, the highly commoditized types of the businesses, and focusing on their alpha, focusing on what makes and gives them their edge, right? I'm going to use a random example here. An active, asset manager, they're going to focus on their model. They're going to focus on, effectively using like an index like from Kaiko in terms of when they're operating one of their funds. And then maybe the execution, they can outsource that to a software, right? Or post-trade and those risk and those capabilities, they would want to use either like a Talos type system to be able to look at everything in one place. So we've seen a little bit of a juxtaposition of folks kind of moving towards that direction and focusing on what their core tenet is as a business and what gives them edge in the market.
Okay, and then Ambre, what are your perspectives on that? The traditional legacy system, crypto ecosystem, how are they going to continue to converge?
Yep. So I think we've seen stuff happen at the two tail ends of crypto TradFi. One of them is like ETFs on Bitcoin, ETH, and now we're going to start seeing XRP and Solana ETFs, and also that is really about putting crypto into a TradFi wrapper and making that investable on TradFi rails in some way. Then we've seen the other side of the spectrum, which is putting TradFi underlying, T-bills, money market funds, private credit. We're starting to see that being wrapped into a tokenized wrapper to be able to be traded on-chain and investable by crypto kind of landscape investors. And I feel that those are two opposed things. One of them is putting TradFi in crypto, and the other one is putting crypto in TradFi. What I'm very excited about starting to see materialize, and I think we're at the beginning of that, is the merge of both, where we can leverage the benefits of tokenized assets or tokens. Like literally, what is the benefit of a token? Is that it's portable, you can trade it 24/7, you can transfer it at low cost, you can actually wrap it into a financial product at a low cost, you can benefit from the kind of DeFi-like applications in how they're efficient on-chain. And if you could do that, bring that world of DeFi infrastructure to traditional financial assets, I think that is going to be, exponentially interesting, and I think that is where we're going to see the real intersection of blockchain and TradFi is when we start getting into the middle of those two extremes we've just mentioned.
I think that's right. And look, as an industry, we've been talking about tokenization for, I don't know, 10 years. And it's only now that we're just starting to see this happen with the likes of Biddle, with the likes of Benji.
Yeah.
Why do you think it's taken so long?
I think it's so there's a couple of things. I don't think it's a technology issue. The technology works. DeFi proves that the technology works at scale, right?
Yep.
I think it's a regulatory, political, issue, and I feel that we've solved most of these hurdles now. Clearly, there's not yet a clear regulatory clarity in the US, but at least there's no we're going to go to jail if we do that anymore threats. So I think that has eased a little bit all of the tokenization initiatives. But still, I'm excited. We still haven't taken that a step further, which is used tokenized assets for financial applications on chain. So whether it's use of tokenized securities for collateral, for lending, I think it's going to be interesting when we do not just use tokenization as a way to address a new investor base, but rather use those tokenized assets to enable applications that are just more efficiently done than in TradFi. I think we're still in a world where the tokenized assets are redeemable only in stables, and then it still happens in a very controlled environment. I think it's going to be interesting when we move a little bit away from that.
That's fair. And so keeping on the DeFi theme then, we've now got to a point where, if we look at global liquidity, DeFi volumes are about 17% of SEX volumes.
Yeah.
That trend is clearly edging higher. I know Talos purchased Golem last year with a view to giving your investors or your clients access to DeFi liquidity in a more seamless way. How do you think two questions. One, how do you think that will continue in terms of DeFi versus CeFi, especially as more institutions come in? And then B, what has been the uptake and how much demand do you see for DeFi liquidity and access from your client base?
Yeah, it's a good question. So I think twofold. The uptake of it has been really interesting in a good way, right? I think we've seen a lot of folks wanting to access those pools of liquidity on chain in a safe and secure manner. So with our purchase of Golem, we effectively allow you to access DEXs at scale with advanced execution strategies that sit on top of that. So you can do a TWAP on Uniswap or something like that, and then be able to look across all the pools and be able to access that similar liquidity in the same feel that you can with centralized exchanges. So that has been a very interesting and actually positive uptake from our community and effectively who's users of Talos. The other side of that, though, is in the same lens, I will say, is the fact that on-chain and trading in DeFi in and of itself is a compliance and nightmare, right?
Yeah.
So especially for traditional shops and traditional funds, because there's an education gap, to be honest. And then the other side of that is you just don't know what pool of liquidity you're accessing it from. We've obviously put a lot of tools in place. There's a lot of firms in this space that have made this a lot more institutional. But the other side of that is the liquidity is getting deeper. That's for sure. But back to kind of the comment I made earlier about moving a battleship, it's effectively, if you're a $7 trillion asset manager, DeFi, and you need to do a risk hedge or something like that, it's probably going to be, it's going to take a little bit more than just one liquidity pool to get that done, right? So you need the proper tools to be able to do that. But I think as it kind of progresses and as education gets a little bit better, we'll see a lot larger of an uptick. And you're starting to see that in the volumes, as you mentioned, especially in derivatives as well.
Yeah. And so I hear a couple of things here. As more institutions come in, which we're expecting and we're seeing from your client pipelines and all the rest of it, it's going to be more difficult for them to access DeFi. So should we expect those percentages, even if DeFi volumes continue to go up, should we expect it to become less relevant relative to centralized exchanges? Does that make sense?
Yeah, I think so. I think, generally speaking, I would say that the pool of liquidity and the depth of the market gets better, right? As more participants come in and as different types of end users, right? So asset managers, real money versus a hedge fund versus a family office, and then you have retail kind of aggregators on the other side of that, right? That's cross flow, and effectively OTC desks and exchanges will need to accommodate for that, right? Whether that be in the tightness of the spreads and prices that they're offering, but also the depth of liquidity that's available, because at the end of the day, a lot of that cross flow is uncorrelated to each other, right? Somebody buying might not be the same seller and effectively there. So I think the markets will become much more efficient through time, but that's could happen, could not. It could take a little bit of time for it to get there, though.
I know, but just in terms of as we see, these DeFi volumes continue to creep higher relative to SEX volumes, for things like index methodology, do you include sort of DeFi price discovery and volumes within those indices? And if not, is that something that you're looking at and keep an eye on?
So for now, we haven't used any, DeFi market data volume to feed our index methodologies when we build financial products on top of that. However, we do look actively at the DeFi market data, and our clients do, right? Even clients that do not trade on-chain will want to look from a business intelligence standpoint at what's going on chain. And I think that is one of the big lessons learned from the 2022 fiasco, where actually if you did monitor what was happening on chain in terms of liquidation events, everything, you could have had some alpha on what was going to then happen on centralized exchanges. So I think that was a nice wake-up call for people who tended to discard a little bit what was going on the DeFi markets, to say actually what's going on there is interesting. It's interesting for two reasons. One, because it's starting to be relatively important in terms of volume, but also because of the automated nature of DeFi markets, you can actually glean some interesting data insights from looking at DEX markets and lending and borrowing protocols, and you can just be ahead of the curve, I would say, looking at that. So from a data standpoint, DeFi and on-chain market data is more relevant than it has ever been, I think. And, but we haven't incorporated price feeds yet into our index strategies. One thing that could be interesting, though, is because of the nature of how efficient it is to execute transactions on chain, it would actually be interesting to consider investment products that are entirely, for which the methodology and the replication lives entirely on chain. And this is something we have explored in the past. It was too early, of you could build index ETF strategies on-chain entirely, where you do a top 3, for example, of top 3 most liquid crypto tokens on DEXs, and you could build a token that replicates a top 3 strategy, and you could invest in that strategy and have everything done entirely on-chain. And this is something that I believe liquidity was a little bit too shallow in the past to have sizable investments, but we're probably going to get to a point where we can reignite those products.
So switching gears a little bit, one of the things that I think is ready for prime time, and I think is really about to take off in a very major way, stablecoins. We're already at $240 billion in total market cap. There's been multiple reports out that would suggest that we could expect that to hit trillions over the next 3 to 5 years. How does that, I'll stay with you, Ambre. How do you incorporate that into your business? Is that something that you need to consider for index methodology calculation? How does that impact what you do at Kaiko?
I mean, stablecoin is going to be a big part of the payment leg of everything we would do on chain. But for us, I mean, we're data guys, right? So we track all the volumes of data we follow. We actually supply market data to stablecoin issuers as well, who need, when it's algorithmic-backed stablecoins, things like that. So that's the extent at which we are involved with the stablecoin world.
Okay. We're almost out of time, but I'd if I could just ask each of you to give me a hot take on the future of crypto markets, maybe something that you believe that you think is non-consensus. Excuse the consensus pun.
I I can piggyback on what we said earlier. I think investment strategies wrapped into a token and executed entirely on chain.
Okay, nice. Tim?
I would say the general growth of the derivatives market and structured products market, and all those interesting kind of, not just like a call option, right? Like something a little bit more than that. As larger institutions look to hedge their book of liquidity, spot exposure is not going to be the only thing that they can do. They're going to look at more sophisticated kind of strategies that will involve derivatives, which effectively may outpace kind of the volumes on centralized, spot markets, if you will. So I think, as we can see from either derivatives exchanges or DEXs or things like that, you can already see the uptick in volume, especially, obviously, there's been some major purchases over the last couple of weeks in terms of that, right? So,
yep.
And that's, effectively my view is just gearing up for that next wave, if you will. I think the spot market is maturing, and it's quite mature now at this point, and the derivatives market is obviously a hedging tool for most folks. So at that point, I think there's going to be a lot more innovation, whether it be through smart contracts, structured products, things like that, but then also just the general demand and the comfortability of that, because it's more capital efficient, it's more margin efficient. Yep. You can effectively trade, maybe get liquidity better. So I think there's going to be a lot of growth in that area over the next 18 months.
Okay, perfect. That's all we've got time for, folks. Thanks very much indeed, guys.
Thanks, everybody.
Thank you.